The great mortgage boom of 2024 is just getting started, so rev your engines and pay attention right now. In 2023 and 2024 so far, there has been a significant holdback in the amount of refinances industry-wide. Yes, there have been people who have been coming up for renewal, and we're definitely seeing those numbers start to increase. But what we cannot forget is one of the primary reasons for mortgage applications to be at record lows is the fact that so many people are quite simply waiting for rates to go down before they start refinancing. So you can expect that by 2024 and early 2025, a refinance boom to absolutely knock the heck out of the water. And the question you have to ask yourself is not only why, but what can you do about it if that's you, and what is going on in the marketplace? So the perfect conditions are just making way right now, with the Bank of Canada counting it not one, not two, but 3 potential rate dips making 0.75% by the end of the year, and new revisions suggesting that from BMO and from Desjardins suggesting that we might see an overnight rate as low as 2.25% in the next 12 to 16 months. The market is shifting, and it's shifting fast. And make no mistake about it, we've got the potential of a recession coming. The high cost of living is catching up for people, and most people are carrying a significant amount of equity in their properties along with a significant amount of debt. We're about to see refinance applications go through the roof between the renewals and the lower interest rates. One of the big reasons that so many people have avoided refinancing and are carrying on a significant amount of debt is because not only the reduction in house prices, but also just generally speaking, interest rates being in the high 6s in the end of 2023 and still in the mid to high 5s. But when those rates start to come back down and the marketplace starts to change both from a real estate perspective, but also from a just general consumer sentiment, the market's going to absolutely shift, and people will start to ask themselves the question, is this the right time to refinance their property? We're going to answer that question here today. So here's an interesting stat. The average amount of equity in the Canadian homeowner's home at this point still stands at $400,000. And if you're looking at a graph, what's most interesting is that number has not significantly changed since 2022 and 2023. At 2022, when house prices had gone up significantly, crazy enough, is the actual amount of average equity was the lowest it's been since 2020 at around $325,000. Now that number went up significantly and of course has gone down, but since that time it's worked its way back up to about $400,000, which means there's a significant amount of equity available for people to pull out of their properties. Now remember this, you can borrow up to 80% of the market value of your home. So what the house would sell for today on the marketplace, if there was a contract or comparables in the area, it will actually allow you to borrow up to 80% of that market value, which means a lot of people have a lot of equity available to do a lot of things with. Now I don't expect people to start going out there and buying, motorhomes and buying boats or going on expensive vacations like they were in 2021 and 2022 when money was cheap. But I think it's actually what's going to happen is now is a time that people are going to consolidate those debts because perhaps the loans are more expensive than the vehicles, or maybe just the debt on unsecured lines or credit lines has caught up to them. And they're looking at this and saying, okay, well, now my mortgage rate is no longer up. I'm not paying 2% anymore. Now I'm paying 5 or 6%. And it is now the right time. And they might not be wrong. Let's be honest here. If people are holding debt right now at a rate of 8, 10, 12, 15, and 20% at around $20, $30, $40, $50,000 and sometimes more, the question starts to arise, does it make more sense for me to go ahead and pay out that existing mortgage and replace it with a loan at a much lower cost? And the answer to that in many situations is going to probably be yes, but not always. And there's no one easy way to answer the question if it makes sense, but I think we can look at it from this context. Is that monthly cash flow causing a significant impact to my life in a negatively detrimental way? And do I have any other ways to pay out the debt? And the answer for a lot of people is no. I'm not able to pay out that debt any other way, and I'm going to use my existing home to help me get out of it. Now, a lot of people out there will say, well, this is a terrible decision. You should never include that debt in your mortgage. The answer really is you have to do what makes the most financial sense for you, but you have to try to set up better guardrails so that you don't do it again in the future. So of course, if you have to consolidate that unsecured debt today and it was something you didn't need to take on, as long as you can learn from that in the future and build out a plan, like for example, adding a certain lump sum to your monthly payment or setting things up in safeguards so you're not just spending money like you did before, then you can obviously use the equity to bail you out and put you in a better financial situation. Now, where people are missing the mark right now and completely forgetting is that back in 2023, interest rates hit the peaks. They were in the high 6s, mid 6s, and low 6s in some situations for 3-year fixed rate mortgages. And there are people who took advantage of the marketplace at that time who can really take advantage of interest rates right now as well. And what that means is that people can actually refinance if they take advantage of a gap before they have to pay an IRD penalty. And this means that they can default to the 3 months of interest. Now, there are certain situations with some banks, namely right now, for example, RBC, where if someone took a loan during that time, they would unfortunately default to an IRD penalty, which could cost them as much as 5, 6, or 7% of the balance of the loan, $20,000, $30,000, $40,000, $50,000 and more in some situations. So there's going to be more than just consolidating debt that people are going to want to refinance. And this is one of the key reasons that we suggest people to be paying attention to how interest rate penalties work and exactly when you'll actually be charged those prepayment penalties. Now, there's a few other reasons that we might start to see people actually turn in their old low rates and look into refinancing. And in some situations, it might not necessarily be to do with debt, but it could be to do with improvements, with the high cost of living and with the changes in a lot of the different guidelines. I believe personally that more and more people are going to ask themselves a question: how do I add another rental space to my property, whether it be 1 or 2, a carriage home, a basement suite, a second basement suite, a locked off room, or something like that. And for that reason, I truly believe that more and more people will start to look at accessing the equity in their home to keep their property and add a component of rental revenue. Specifically, with a lot of people moving from overseas, there's more opportunities for furnished rentals, furnished rooms, and having that equity to be able to complete that renovation could change things, notwithstanding the fact that many Canadians are considering downsizing and living with family members. We might see the shift of wealth for people actually looking to move into family homes, and not everyone is flush with money to the point that they can just pay cash. They might opt to refinance and include that debt when they're actually adding in that second suite for their parents. Now, another subset of people that might be considering looking for opportunities to actually access the equity in their property is one that I've seen more and more of over the last 6 months. Now, this is anecdotal personally, but I do believe that it is a trend and will start to happen. There are more and more businesses that are actually, believe it or not, still succeeding despite everything that's going on. And a lot of those businesses have opted not to take on capital from their existing properties and get it from, in some cases, more expensive resources. Many of those people start to look at the consolidation of equity and consolidation of the business capital or business money that they spent with those loans and consolidating that into their property itself, which means to include that in the loan, or look at the possibility of investing back into their business by refinancing and using the equity in their property at that time. If we see different people look at these different strategies, notwithstanding the fact that mortgage rates are coming up for renewal, the fact that we have a lot of people who have taken on high unsecured debts, people are trying to negotiate lower rates and look at the investment into other different types of businesses and much more, chances are that we're going to see a significant amount of refinance business be coming up in the next year. And then if that's you and you're curious about it, what you need to know is a few things. Number one, what's your prepayment penalty and how is it set up? Because that can change as time goes on. Number two, why are you refinancing and does it make sense from a payment perspective or an interest perspective? And number three, you gotta work with someone who is honest, who can actually assess that situation, break down a table and show you the difference between the existing amount that you're paying versus what you'll be paying after the fact. If that sounds like you and you are in a position where you want to take advantage of lower rates, refinancing the expenses that you have right now, adding a renovation or looking at accessing in capital, I'd love to help you out, see where we can take care of you on our team. Hope you found some value in this video. We'll see you on the next one.